Well, after a rocky start to the week, given the anticipation and unknowns of inflationary data, like many, I ended up buying this past week more than $5,000 worth of stock. And now as I gear up for the week ahead, I'm here to say there are still deep discounts that are out there for you to take advantage of, 7 of which I'm going to break down today, just after I talk about some of the need-to-know macros. With that, let's dive right in. So we're going to go ahead and just dive right into arguably the most pressing news for all investors regardless of your strategy. Whether you're into dividend growth stocks, just dividend stocks, or just growth stocks, any investor here has to really understand the market mandates. There are 2 that are front and center: interest rates and inflation. And guess what? One is totally dependent on the other. Now, as an investor, you need to pay attention because depending on the data, the market either reverts back into bear territory or veers bullishly higher, as evidenced just this past week when the market actually slid before the latest inflationary data was released. So what exactly happened? Why did the market react as it did? And how in the world are we already back on the up and up? Well, first and foremost, what happened? Just before the latest CPI report this past Tuesday, investors were all wrapped up in whether or not inflation would actually rise sky high or drop down to lower lows. Now, we actually experienced a pullback, meaning the vast majority of market participants expected a higher inflationary reading, and that's exactly what we saw, as inflation rose by about 0.1 of a percentage point, higher than the forecasted rate, currently now sitting at 3.8%, which isn't good for you, not good for me or any consumers nor businesses or really anyone who understands money. So then what gives? Why did the market spring right back to life thereafter? Well, first of all, it's sheer predictability and the ability to model out an interest rate cut calendar, if you will, which leads me to talk about mandate number 2, interest rates, to which all of us investors want them down more than anyone, as it's great for razzing up the economy. But that doesn't explain the run-up now, does it? I mean, rates didn't change. It would all come down to predictability. The market enjoys certainty, and even if the news isn't as pretty as we'd like it to be, or the data doesn't point to the greatest possible news, it's all about understanding the market where it could be and certainty. So there you have it, a whirlwind of volatility, short-lived as the data provided more certainty to calm the markets. But this is now the big question: where do all of us invest? Well, as I always say, we invest into quality gems out there that will allow us to invest right now, not worry much, given their sheer stability and most importantly, the ability for all of us then to enjoy profits, whether dividends or share price appreciation. Just invest in quality, folks. That leads me to dividend stock number 1, Pepsi, ticker symbol PEP. Now, for those of you who have been following my channel, I know you've heard me mention Pepsi quite often. And time again, when I mention it, that green flag of yours should be going up, because as Pepsi is one of the most dominant soft drink manufacturers and salty snack kingpins, with famous brands from their classic Pepsi or Gatorade to their Cheetos or Doritos, this slump will be short-lived. So take advantage of it while you can. The share price remains depressed, down from its 173 highs, trading for $164 per share as we speak. Zoom out with me here to actually see just how much Pepsi has climbed over the past decade, appreciating over 167%. We also have analysts who continue to give Pepsi their stamp of approval here, forecasting 16.31% worth of upside, coming up to $191.38 per share. Now, because I spoke so much about Pepsi, I'll just keep it at that and divvy out some dividend metrics for you, to which Pepsi is currently coming in at a 3.29% dividend yield. It's been on a dividend streak for the last 59 years, and get this, it's been growing year over year for the past 20 years at an average of 11%. Next up, we're going to cool it on the Cheetos and put the bag down and talk healthcare with United Health, ticker symbol UNH, which is a health insurance behemoth in the United States. Given we all know the state of the healthcare system in the United States, I'm just going to go right ahead and say this: it's about right time and right price with this one, making it a buy in my book if you're looking for a long-term, reliable, dividend-growing company. And the good news, as of this video, it is the right time, as United Health is down by roughly 6.6% on the year, trading for $489 per share with a PE ratio at 20.5. Not likely to duck below that level, so heck, grab it now because it's already back on the rise after climbing by a little over 2% last few days. But zooming out here, we can see over 643% worth of share price appreciation. As for analysts, they foresee over 22% worth of upside, coming back up to a share price here of $599.14 per share. And all in the meantime, you can enjoy the 1.54% dividend yield. That's been experiencing 41% worth of growth year over year for the last 20 years, while remaining on a dividend streak for the last 31 years. Now, investors, you just got 2 out of the 7 dividend stocks, but before I move forward with the next 5, I just had to share some fascinating data with all of you. As I went ahead to look at the back end of my YouTube channel, it says here that since the channel started, 83.3% of all of you who have been watching my channel frequently haven't yet subscribed to the channel. So I have a favor to ask all of you. If you are enjoying my videos, I want you to go ahead and join me on this journey by subscribing to the channel. It helps me more than I can ever explain. And as a promise to you, if you do just that, to return the favor, I'm going to go ahead and continue to produce higher and higher quality content for all of you. Now, while you're at it, tap on that thumbs up button just to let me know that this is in fact the type of content that you are looking for. I'll keep creating videos just like this. With that, investors, let's get back to it. Dividend stock number 3 and talk John Deere, ticker symbol DE, an agricultural heavy equipment manufacturer that has been beaten down thanks to our economic environment, whereas all of the cost cutting and saving measures taken by their primary end consumers have really impacted the company. So now, luckily for all of us, Deere continues to trade at lower lows, coming in at just $372 per share at a P/E ratio of 10.9, which is a hefty downfall from over $400 per share at the onset of the year. But as any good farmer knows, seasons come and seasons go, to which over the span of a decade, we have over 416% worth of share price appreciation. Now, at these prices, you better believe that smart money has been making their money moves, scoring more shares. Matter of fact, last quarter, over 1.2 million shares purchased. Analysts who also remain bullish, as we can see, over 12% worth of upside expected, coming up to $420.94 per share. But that isn't all. The cream of the crop here, if you will, with John Deere is the dividend, coming in at a 1.58% dividend yield, making for another higher growth opportunity. After a 30-year dividend streak, still going strong, Deere has averaged about 13% worth of dividend growth year over year for the last 20 years. However, you very well may be looking for a bit larger of a dividend and a comeback player, to say the least. So I'm going to go ahead and gift you with Target, ticker symbol TGT, as an idea for the week ahead. As you know, Target is one of the largest big box retailers in the United States, the 7th to be exact. And since COVID, Target has really struggled as competitors like Walmart, known for cheaper prices, and of course Amazon, took center stage. Now, as Target suffered from lower sales, stockpiles of backlogs, inflation, and just an array of upsets, they recently reported very strong earnings and blew right past everybody's expectations. Now, I think personally Target is the best retailer out there, but I'd certainly love to know your thoughts on Target when you shop there. Drop those comments down below. No, this is not an ad for Target, but I certainly want to know your shopping experiences. Anyhow, if you are going to invest into Target, the time is actually now, before it continues to climb back up. It's trading right now for $167 per share with a P/E ratio at 18.8. That's up by over 18% on the year already. Zooming out here, we can actually go ahead and discover 273% worth of share price appreciation, along with analysts who are favoring Target, with forecasts hitting $177.36 per share, all while hedge funds have been scoring more shares as well last quarter. The real win with Target, aside from that share price comeback, is the dividend, with the yield coming in at 2.63%. Rock solid dividend history here, 52 years of a dividend streak, and 15% year-over-year growth over the last 20 years. And if Target is in fact a comeback play for you and it sold you, I'm sure you're also going to appreciate the opportunity to soar with United Parcel Service, ticker symbol UPS, which is arguably the logistics kingpin, yet completely battered down by our economic environment, and more specifically cost-cutting measures by big businesses and even consumers like you and I, who are out here not trying to spend a heart and a lung just to send a package or two. Logistically speaking, I think they will be back. So have at it here when the share price remains down on the year by almost 10%, trading for $157 per share. P/E ratio here still below 20 at 19.8, yet a green performance over the last decade with 121% worth of share price appreciation. Now, as of this video, our analysts out there continue to remain very optimistic about UPS, forecasting more growth, coming up to $165.44 per share. But actually, if I'm being honest, the smart money moves that have been made on UPS have been all the rave for me. Over 2.1 million shares purchased last quarter. quarter. And regardless, the UPS shareholder will also reap the real benefits and power of dividends with UPS, thanks to UPS's dividend yield coming in at 4.14%, which has been on a 25-year dividend streak while growing that dividend along the way by an average of 10% year over year for the last 20 years. Now, many of you know that I cannot help myself when it comes to Lockheed Martin, ticker symbol LMT. But I want you to hear me out just briefly on this one. The world is basically in total shambles and truly in need of arming the good guys to really silence all the bad apples out there in the mix. And while I'm no war hawk, like good old Uncle Sam, I am here to say that I stand by and continue to support the United States military and all of our allied forces. What is more, no matter what happens this upcoming election, whether you're Team Biden or Team Trump, they will continue, and by they I mean the United States government, will continue to pour money into Lockheed Martin as they remain the company's largest client. I mean, just 8 days ago, Lockheed actually secured a $219 million deal with the Army. 12 days ago, another $663 million deal. Now, investors, that's all happening during the quote-unquote bad economic times. So just imagine the better times to come. And what remains so right now is the stock down on the year by 6.3%, trading for $434 per share and a P ratio at 15.8, making me a fan, especially when I can see over 248% worth of share price appreciation over the last decade. Not to mention, we also have analysts predicting more upside, with a forecasted share price coming in at $477.60 per share. But of course, I'm invested into Lockheed for the dividends, dividend yield coming in at 2.9%. That's been ongoing for the last 31 years, while growing on average by 16% year over year for the last 30 years. However, perhaps you're looking for more reliability, dividend growth, and even a higher dividend yield. Well, in which case, I have an all-in-one opportunity for you with Amgen, ticker symbol AMGN. Like all biopharmaceutical companies out there, this past year has been overlooked. So here we are with Amgen actually down year to date by a little over 3%, falling from $324 per share to $276 per share. But zooming out, we're going to see almost over 200% worth of share price appreciation. And of course, I just want you to bear in mind the role that big pharma and the industry plays in our lives. As we all strive to live longer, healthier lives, well, we can check in with the analysts and it would be a no-brainer to then see them forecasting more upside, climbing back over $300 per share at $316.07 per share. That's nearly 15% worth of upside. But until then, we get a 3.25% dividend yield to enjoy, which Amgen has been right on this dividend streak for 12 years now and experienced 16% worth of dividend growth year over year for the last 10 years. Now, investors, there you have them, all 7 dividend stocks. Let me know which ones you actually own or you're interested in owning. Comment down below, especially if you have better ideas in mind, but catch more insights right here or just subscribe to actually join me on this journey.